Good afternoon and welcome back to Freight Forecasting. I'm your host, Michael Vincent, and with me today is my very good friend, longtime friend as well, Zach, the Sultan of SONAR, Strickland.
Hello.
Welcome to the show.
Hello. Hello, Mike.
How you been doing?
I've been doing well.
Great. Have you been watching the show?
No.
Excellent. So, freight forecasting, what we're doing is talking about the importance of and how to freight forecast, right? And we've been going through the different aspects or perspectives of it. We went through econ, we went through shippers, brokers, and carriers very briefly, high level with Donnie Gilbert, the insightful Donnie Gilbert last week. And so this week I have Zach here. He's kind of looks at it from all angles. Zach and I worked together in a previous life for many years.
Yes, very long time.
Yeah, very long time. Very smart, analytical, trying to forecast that type of stuff. In former life, trying to teach bosses that, yes, winter comes every year.
Yes, it does. Typically, I don't know if you know this, Mike, but trucking has seasonal cycles.
It does.
Yeah, just like the seasons.
No kidding.
Yeah, so, typically you have volumes that ebb and flow throughout the year, and they actually correlate with the actual seasons.
So you're trying to tell me that at Christmas time when everything slowed down this year, that happened previously as well?
Yes, it's happened just about every year.
Wow. Next you're going to tell me that produce season's going to come.
Oh, probably.
Excellent.
With 100%.
100%. There you go. There's your forecast. There's your forecast. But seriously, looking at these different things, so we're looking at, you need more data than just one or two different data points in order to be able to forecast accurately.
Yes,
right?
Yes. So I think a lot of the fallacy that, I myself have been, privy to back in the day.
Yeah.
I thought I knew all of the information I needed to know.
Right.
Back at our previous existence.
So the interesting story there that we're kind of both looking at each other knowing is when I was here.
Yes.
And you were still there, and here was like four of us.
Right. There were like 3 or 4 of you.
Yeah, that's it. And you called me because
I call you
because yeah.
But yeah, we were
a lot.
Yeah, we were having this record-breaking revenue. People were calling in all the time. We had just huge amounts of volume, and
so it was like June
of 2017.
2017 top line revenue is like 20% year-over-year growth, just through the roof.
We had just gone through a big transition. We just started a new program with a new account, et cetera, et cetera. So it's like I'm the financial analyst. I'm the only one there that's like searching through all this stuff because I'm the only one there that knows where all of it is.
Right.
And I'm thinking, oh man, we totally misbilled a bunch of customers.
Billing errors.
Because we had a record revenue month, and everybody was just super celebratory, et cetera.
So, and this company was a quasi-asset-based LTL.
Yes.
Right.
Accurate. So I'm looking around. I'm going through all the numbers, and our average, freight bill, revenue per bill was up about 10 to 20% on average.
Yeah.
And our average weight per bill was up 140%.
Right.
And I was just going, this doesn't, I can't find it anywhere. Just normally there's like this big golden goat just staring at me.
Well, I remember I was driving into work in my car about noon, and you were going through this. What is going on? I don't understand what's going on. Everybody, the guys are, the C-suite is popping champagne corks, and sales is doing their job, and whatever we did that worked is working.
But
right?
we literally had just come out of one of the worst periods of time. I mean, in March, just a few months earlier, we were having discussions about like cutting costs, trying to like just make it through, all this kind of stuff. I mean, it was like a struggle. We were on the struggle bus for like a good solid year and a half. And all of a sudden, out of nowhere, record month. And it was June. So you're looking at this record month in the beginning of July, kind of looking back at it going, what happened? Yeah.
And so you're trying to figure out, why were we successful if we really were, not one? Let's analyze this and figure out, were we successful? Then if we were, how did we do it? But the brain trust was running around going, who cares? We were successful.
They didn't care.
Yahoo!
They didn't care. And I was like, guys, you really should, we should at least figure out what we're doing right. And they, and then you start having these kind of confirmation biases that all set in. And you're like, well, it's because our service is so much better. And I'm like, well, service, I knew our service wasn't that much better, and certainly it hadn't been better long enough for it to make that kind of an impact.
Yeah, I mean, if you're starting to improve services and so on and so forth, if you've discovered that's part of your downfall and that's what you need to do to gain and further penetrate the market and so on and so forth, it doesn't happen from Friday to Monday.
No, it's not like all of a sudden our service was 20% better. Even if it were 20% better overnight,
It's not going to do that.
it's not going to turn the revenue up that kind of level. And
Right, and so digging into the stuff, you figured out that it was volume spot quotes, right, or larger shipments.
So what had happened? See, what had happened was, so I called you up,
Yeah.
and you tell me, well, dude, produce season kicked in. Nobody can find any trucks anywhere. Record produce, da-da-da-da-da.
Well, the rains returned to Southern California because
Yeah.
there's a huge drought, and they came in a big way. So
They
there
were
was
saturated.
major produce season, but it was also delayed a number of weeks as well.
And what this did was, along with a few other factors, such as, the economy kind of ramping back up. We just finished our election year, and so tax incentives, et cetera, made companies really go out and start spending more money.
Right.
But it was also summer, so we got like this kind of trifecta of a wave effect at peak season.
Right.
So the produce season happened, and then of course this all affects dry van volumes as well. We had some reefer carriers that were backhaul, and
Yeah, because the majority of the freight was coming out of the southeast.
yes, almost all of it out of the southeast, but we did have a lot on the west coast as well.
Right.
But a lot of our customers, they weren't getting coverage. Capacity literally just went off the board.
Well, that's what we were talking
For
about.
2
is,
weeks.
is I was telling you,
Mhm.
you can't buy a truckload from our market to Dallas for like less than $4,000. It was insane.
That's exactly
how
right.
expensive it was.
So I call up. I call up Trey in our brokerage department after I talked to you, and I said, "Hey, Trey, man, what's the story? What are you seeing out there right now?" He's like, "Oh man, you won't believe it. I'm having to cover loads for like $4,000 or $5,000 that cost me like $1,000 last week. I cannot buy a truck." Our line haul department, Mandy, she's down there just doing. She's pulled out her hair already.
Yeah.
And they're all just like, "Hey, yeah, this capacity has been completely gone out of Atlanta for the last 2 weeks." And so I start digging in, and of course there's a lot of our shippers down there had chopped up a lot of their truckload,
Yeah.
and they
Right.
started chopping up all the truck, because LTL is not like truckload. It's not like accept decline.
What?
Yeah, I don't know if people know that, but LTL, less than truckload, they chopped up their truckload shipments into LTL shipments in order to get the guaranteed capacity that LTL provides. LTL will reject.
Yeah, so when they went out to the LTL market, they took a full truckload, dropped it into 4 shipments,
Yep.
chopped it into 4 shipments, and said, well, we'll just offer it to LTL and get ourselves some spot market volume contracts, nice, cheap, fill
Yep.
up the volume for the LTL
Well, it's not
carriers and move
cheap,
it.
but
Well,
it's guaranteed capacity.
Yeah, it's guaranteed.
And I guess it was relatively cheap.
It's relatively cheap to the LTL carrier because they're just using it to fill cube,
Mm-hmm.
right?
LTL carriers do not want to turn down freight because freight moves freight.
Freight moves freight. Service got to go,
It's got to cut.
and you need it. You need to cube that thing out.
Yeah.
Right. I mean, it's similar to truckload. You want to you're looking for backhauls, right? In a backhaul market,
Yep.
we've all had that, where we've bought capacity out of Miami just to paying for the fuel and maybe an Arby's sandwich on the way out,
Right.
right?
But I mean, the point is that most people look at year over year, and they project out. I mean, you and I sat down and we looked at sales budgets and stuff.
That's right.
And you're always just basically saying, well, I think we can do 5% better. You try to assign some science to it at times, and you're really valuing the year, previous year, to project out the next year.
Right.
You don't
Right.
really know that it's going to be like this explosive, season,
Yeah.
if you will.
Yeah, you don't know what you don't know. If you're looking at year over year seasonality trends over the years, they're all different.
And if you're projecting
The day it starts is different.
Yeah, and if you're projecting 2016 onto 2017,
Yeah.
you were very wrong.
You were very wrong. You were very wrong. But you were ahead of the situation you were in,
Yeah,
because this is a prime example of a company that had a pretty decent knowledge of what they did,
yes,
right? And it was a niche carrier. We won't say what it was, but it was very niche in the commodities that they moved and the customers
Sure.
that they served. Very, very niche.
niche, so very limited.
Certainly
scope.
was not produce.
No.
In any way, shape, or form. Not even close.
Right.
Right. But produce messed up the revenue in a bad produce truckload
Yeah,
destroyed
I would have
the
never.
revenue. Well, the profitability for a
Yes.
lunch for a month for a niche, extremely niche LTL carrier.
Yes.
Is that what
yeah.
you're trying to tell me?
Yes. Yeah, produce.
It's
Like
interesting.
reefer produce, like all this stuff destroyed, had nothing to do with produce.
Absolutely nothing to do. The business had absolutely nothing to do with it.
No.
So the point is you have to be looking at other things.
Yes.
You have to be looking at outside of your scope. That's a real live example.
Mm-hmm.
It happened. We lived through that phone call.
Yeah. We laugh about it
Several
now.
of them. We laugh about it now. Well, no,
But
that's
I was-
funny at the time.
I look like somebody out of the 1980s law firm, like just throwing papers around looking for the bug.
Right. And most people have experienced this type of thing, and some have figured out what the issue is and then improved. But I mean,
Right.
that's the point of this show, really, is to educate those people and to affirm what most people know but don't take action on.
Right.
Is you've got to get those other data sets in. You've got to be projecting out what is going on. The things that are happening around you affect you. It's just like a market is not necessarily insulated from the markets around it when you're talking about truckload, right?
Yeah.
And modes of transportation are not insulated from other modes of transportation. And
Correct.
certainly they're not, insulated from random tweets.
Right. No. Yeah.
Right?
Yeah. Our president has proved that.
That's right. So, yeah, excellent.
Yeah.
Very good. So let's jump into what you got.
Yeah.
Zach Strickland, Sultan of Sonar. This is Z101
All
with Zach. And just like other shows, and we've had other guests, we'll stay kind of high level this one, but we'll go into some of those things that are showing you some of the fallacies or errors that you can make, I guess,
Yeah.
looking at these different things. And then as the shows progress, we'll really dig in and show you what you can do about this type of stuff and what are those data sets. We'll discuss some of those, but we'll dig into deeper detail next time Zach's with us. So if we look at this first dashboard here, show me what's going on here, Zach.
So we have the Cass Freight Index shipments. So this is a measure of how much freight volume. It's an estimate of how much freight volume is moving through the country any given month. It's a monthly index based on about 50% truckload. The rest of it's got parcel, LTL, some intermodal and rail in there. So it's a good, nice, broad picture of what the freight market in general is doing. It is not entirely truckload, but it's based on invoices. They represent about $28 billion worth of transportation spend.
That's a lot.
Yeah, it's a good, healthy sample, and it's pretty accurate. I mean, we were talking about 2017,
Yeah.
2016, 2017. It's pretty representative of our experience. Would you say?
Absolutely.
Yeah.
Yeah.
I
no
mean,
doubt.
we definitely had a suppressed economy in 2016. Industrial activity was really down. The oil market collapsed.
Right.
People shut down oil wells and all this kind of downstream effect, less production, less activity.
Yeah,
et cetera.
you look at that spike in July.
So and then
217.
yeah,
That's when you called me right there.
I was like, geez.
Yeah. So that's the blue line, right?
That's the blue line.
All right.
On top of that, the orange line there is the DAT Freight Futures National Index, average of the spot rates, for our futures lanes,
Right.
highly representative of the spot market activity for the truckload market in the United States, and a rate per mile average excluding fuel.
Right.
So you can see the basic seasonality of the truckload market here. So you're looking at the orange line, and you see about every July 4th and around Thanksgiving/Christmas-ish, which is fascinating to me that actually kind of oscillates a little bit every
Yeah,
year.
it really does. It does.
But there's traditionally about a 21-week cycle in between these two peaks on average.
Mm-hmm.
So you can see, and the way I look at this is you're looking at the peaks and the valleys of each year. And
Right.
that really, because you're looking at, weekly index and a monthly index. Some of there's some noise if you get too granular with it, but at the same time, if you're looking at the tops and the bottoms of the lines here, you can tell the direction of the market itself. So the way I kind of look at these is when you're looking at the two peaks from July to Christmas or Thanksgiving, however you want to look at it, that's the direction of the freight market. You look at 2016 right there, and you can see that it's an upward trajectory. Now, if you were operating in January of 2017 just on volume alone, you're thinking, oh, darn it.
Yeah, right.
Here we go.
Yeah.
Here we go again. Nothing's really changed.
Nothing's changed.
And you can see
same
the
old.
spot rates bottom out as
Right.
well.
Right.
But
Yeah.
then all of a sudden, look what happens in June, July.
Boom.
There we are. It's almost like a carbon copy of what
It
we
goes up,
experienced.
plateaus at a new high,
Yep.
goes through 17 at that new high,
Mhm.
and then continues to skyrocket.
Right.
right?
It just
It's like
pushes right.
shoots to the moon, hangs out in orbit for about a year, and then shoots to Jupiter.
Yeah.
That's basically what happened.
Right. And
Right?
if you were to place 2016 and say, well, 2017 is going to be, 5% better. No year is ever 5% better. And yet we all try to project out like 3 to 5%. I guarantee you, anybody that's watching that's done a budget in their life knows that you're throwing about 3 to 5% on numbers, expenses, revenue estimations, any of that kind of stuff. And you're just kind of, there's my finger in the air.
Right.
5% on top of that, because everybody's almost forced to project that amount of growth.
That's right.
It's a safe amount of growth, but
it's a safe range where if you're sandbagging a little, you won't get called down on it. And if you're stretching a little bit, it's still doable most of the time, right?
Well, it's a safe bet, and you can sell it to your bosses and whoever you're wanting to do. But if you are the boss, you are the executive in charge. You're the guy trying to convince your investors, your stockholders, whoever the person that you're trying to convince that you're going to be successful this year too. If anybody looks at any of these charts, they're going to be like, well, no year is ever that even.
Right. That's exactly right.
I mean, you look at this one right here. It's like 2015. If you projected into 2016, you'd been dead wrong. 2016 into 2017, totally
That's right.
wrong. And then a lot of people.
So what's going on here, though? So volumes.
Yes. So you have
and
volumes
rates are following
rates.
it, right?
Correct.
So why aren't I just watching the volumes and trying to do some trending on what the volumes are going to do, and therefore I'll know what rates are going to do, and boom, I got my budget.
Yeah, exactly. No, you wouldn't do that. That's not going to work, because if you look at what happened in 2018 to 2019, so volumes you can see actually were higher than 2017, but rates fell below 2017.
And how does that happen?
So oversupply.
Oversupply. So I mean, you again, volumes, right?
Yeah.
The point you're looking at it, you're looking at an index. Mm-hmm. You're looking at this trending of the volumes, and you're trying to gauge, okay, where are rates going, so I can get a good solid sense in my budget, in my forecast of what I'm going to do sales wise, et cetera. Mm-hmm. And since volumes are doing well, rates obviously are going to go up.
Yeah, everybody.
Not so fast.
It's so intuitive for people to relate volume to increased revenue, increased profit.
Right.
And it's just not accurate, because if you look at what happened here, and I mean, we know now, I'm not going to, piddle around with the reasoning, but, a bunch of carriers entered the space. They bought a bunch of trucks.
Yep.
Because they got a lot of revenue real fast. And it's because they got a lot of revenue out of a down market. So they got really excited, and they were like, we can afford this.
Trucks. Let's get some new equipment. I had a rather large 4PL, asset and brokerage based, who was very, very interested in during 2018 at the peak on used truck prices, because what they had been doing was buying new equipment, bringing on new equipment, but not selling off their old like they would cycle through it. They were just adding more and more and more capacity to take advantage of these rates. And what they were trying to figure out is, when do I dump these older before they lose their value, right? So that's indicative. That was going on. That's what was going on.
That's huge. And I mean, that's just a little side event of what you can do with some of this information. But I think the value here is where you can, we've built models here that actually take some of this into account in terms of, you really want, if you want to build a robust model, you need to have a multivariable model.
Yeah.
All that is just more than one
set of
data point.
One set of data can predict it for a while, but the correlation is going to fall apart eventually.
Yes, exactly.
In most cases.
Yeah. So
we move on to the next one here?
Yeah. So that one was more indicative of spot market. So you're also, obviously the truckload market, or the trucking market in general, it has a spot market, which is about 15% of the market at any given time on average. Obviously it fluctuates up and down with volumes. And then you have the contracted
side,
right, which is, of course, the bigger, more representative of what's going on in the United States.
Absolutely,
85% or so of the overall volume. So I have the same information in green that we had on the last one, which is the cash shipments index. That's volume.
That's volume of shipments.
And then I have the cash expenditures. Now, the cash expenditures is more representative of this contracted freight.
So before we were looking at volumes, and for a while there, they correlated, and you could predict really where the rates were going for a while. And then it all fell apart because we had this influx of capacity. So that's where demand doesn't have an effect on price
Exactly.
anymore. Now we're looking at contracted.
Yeah, because a lot of people, I mean, like I said, 85% of the market is contracted. So that means that you are, when you're projecting rates, and if you're trying to use just the, the spot market to project rates forward, you're going to be way wrong, because
Way
that
wrong.
blue line right there is a contracted rate.
It's contracted rates.
And it's because contracted rates are operating normally on about a 12-month cycle, annual bids. Some of them are multi-year bids, but they're a lot stickier than they are the spot market.
Right.
The spot market
Right,
is
right.
exactly what it sounds like. It happens on the spot in the moment, and it's very volatile, et cetera. Contract rates do not happen like that. Bids come out every year, and then you have to hold them for 12 months at minimum generally.
That's right. And if you look at this chart at the end here, and it's like right behind Zach's head there. There we go. At the end of 2018, when you normally, the green line, right? So if you look at 216, 217, you see it drop off and just die, take a nosedive right at the end of 217,
Yep.
Christmas season, what have you, right? In end of 217, that didn't happen.
Nope.
It
Kept
didn't
going.
die off like that, and that's really the upward pressure stickiness of contract rates, where they
Right.
said, "Ooh, we don't need to sell our equipment for nothing, our capacity for nothing, because we're full of freight and the volume is coming, so we can get ourselves
Right.
an increase finally on our contracted rates," and that's what stuck and went through
Exactly.
18.
And then it lasted through 2019. I mean, look at those expenditures. They're still up there.
Yeah,
I mean, it's not like they just took it all away overnight.
right.
So again, there's a big difference between if you're using, spot market to project things versus, especially if you're applying that to contracted.
So would you
freight.
say these two are utilizing these two together is important, because one of them is more of an immediate reaction to things that are happening. The other's a little bit slower moving,
Correct.
yet they kind of
They move
lead
together.
or follow and move each other. So you can gauge the stickiness of the contracted by what's happening in that really quick moving
Right.
LTL or spot
market.
and really vice versa.
Yeah. No, it moves kind of like two waves. They kind of operate
Yeah.
on their own little oscillation.
Right.
And the spot market, the longer it stays elevated, the higher the contract rate will get pulled up. You have
Awesome.
to think about the spot market definitely leads contracted, but the spot market doesn't have the strength to pull the contract market
No.
on its own, like by its, if it is a short-term spot market increase.
Right. Cool. Let's move on to the next here. What are we looking at here is rejections and volumes. And this one's kind of interesting here as well, right? Because now you're talking about rejections, which is your blue, right? Your mountain is looking at the tender rejections, or
Tender rejection index.
Amount of loads being rejected
So the
by
higher-
carriers.
Correct.
Or they can't handle it, or
They have a better option.
they have a better option. Let's say they have a better option. So this is really the effect of demand on capacity, right?
Correct.
And then the orange is the volume of loads.
Yes. So the outbound tender volume index measures, basically it's a proxy for the volume of loads moving through the United States, pure truckload. There's reefer, dry van, tank, intermodal, and some flatbed in here. So it's pretty much a truckload market that you're looking at here,
Right.
whereas the CAS has 50% truckload and a bunch of LTL and parcel and other things in there mixed with it. So the interesting thing here, again, just to isolate the truckload market, you see the volumes are relatively stable. I mean, those troughs there, of course, are the 7-day moving average around the holidays
Right.
that really kind of, dig it out for a minute. Christmas.
Yeah, Memorial
is-
Day,
exactly.
July 4th.
Everybody knows these trucking holidays.
Yep.
And, the interesting thing here is that it's not a one-to-one relationship. Volumes are actually up 2% year over year as of today.
Right.
And tender rejections are down 28%.
So that doesn't make a lot of sense, does it?
Not if you're trying to project the market on volume.
So you gotta look at capacity.
You got to
is
look
what
at
you're trying to say.
capacity. You also have to look at market balance. Like, it doesn't just matter like that you have trucks available in the United States. The trucks have to be where
in
the
the
freight
right
is.
locations. Yeah, because I mean, even looking at this here, you say, okay, well, this is what's happening in the United States, but we talk every day, and we're forecasting every day. I was doing forecasting for a major shipper over the last week, building out different dashboards, et cetera. And specific markets, they're losing their butts in specific markets for weeks at a time or whatever, even though it's pretty smooth and rates are pretty low and everything else. But the shippers they get killed in a specific market with service, product not moving, dropped loads, and dropping out into a spot market, which in that isolated area is going through the roof.
Yeah. Isolated area. The key.
Right.
Yeah.
Yeah.
It's not always the United States.
Right. Right. So you got to be looking at everything.
Yeah. And just to illustrate that.
Right.
On the next one. So everybody knows last year, big tariff issues. Trump had the trade war thing going with China, caused a lot of shippers to panic, caused them to actually reevaluate their supply chains, et cetera. You can read about all that on FreightWaves
ad nauseum.
Or any of our media. We've talked about it a lot. But to illustrate that point, if you're operating within a market and you especially in something like Los Angeles or Elizabeth, New Jersey, you have other things outside of your world that impact how your freight moves, such as imports.
What?
Yeah, stuff that doesn't start out on a truck. I don't know if you know this, but a lot of the freight we move in the United States doesn't start here.
You're kidding me.
Yeah, that's fact.
Comes from other places.
Other places.
Wow. So that's what those big ships are.
Yeah, specifically China for the most part, but it's starting to transition to other parts of the world, Mexico, Southeast Asia, et cetera.
Right. Just knowing that these two different markets are changing is pretty good. I mean, when you're looking at your different isolated markets and how they're interacting with each other and what is changing, instead of looking at this broad region or the United States in general to gauge your business, no matter if you're a carrier, shipper, or 3PL, it doesn't matter, intermediary, right?
Yep.
That once you start getting more granular into the actual markets and regions, that's better. But then why are those specific markets acting that way?
Right. So
that's what we're getting into here, right?
So the reason that I picked this chart here is because this is a good representation. Just like the produce season wrecked us in Atlanta.
Yeah.
Los Angeles, what happens around the country in these bigger markets, such as Los Angeles, Elizabeth, New Jersey, impacts the rest of the freight market. If you were to not understand why the market was moving or where it was moving to, you'd have no prayer of projecting out the next year.
Right.
So Elizabeth, New Jersey, there in the green, volumes up 27% year over year. Los Angeles volumes down 18% year over year.
Yeah.
And that's because the diminishing impact of the trade war and
that's exactly. But before this happened, we were watching
Los
the
Angeles
imports, and we were watching the price of TEUs, China to the west coast of the U.S., and we were watching the volume of TEUs and shipments moving and watching it change from east coast or west coast to east coast, and saying this was going to happen.
Right.
So you could have been ahead of the game if you were looking at that as well, right?
Whether
you're involved with imports and international trade or not, if you're shipping from or you have assets that move or you have business going on in these two things, you need to know what's going on throughout the world to understand what is going to happen to your business and be able to forecast accurately.
Absolutely. And if you look at May right there.
Of course, absolutely. I said it.
Yeah, I know, right? How can I ever dispute it? If you look at May right there, we had a huge plummet out of Los Angeles in May, right around May 10th, when Trump was like, hey, we're going to raise those tariffs another 15%. All of a sudden, right after that, shippers was like, you know what, flip the switch. Coming to the East Coast now.
Rock and roll.
All that Southeast Asia stuff comes to the East Coast a lot quicker than it does, than it did coming from China.
Yeah, because it takes a different route.
Yeah, it goes through the Suez.
Right.
So also it's closer to the population. A lot of this freight goes to L.A., sits in a warehouse for a few months, then it gets on the rail or over
and we can look at that when we dig in deeper, but I've shown that before to people is how it has actually changed the surface transportation in the United States changes tremendously as far as the rail and so on and so forth. And then all of a sudden you have to start thinking about these things like you come into LA and you got to truck it 3/4 of the way or 80% of the way across the United States to get to the vast majority of the population. Now, if the freight is coming in majority into Elizabeth, Port of Elizabeth, New York, New Jersey, right there, you're there already.
It's going 100 miles.
Yeah, you're going 100 miles.
Not 2,500.
Not 2,500, right. Yeah. So what are we looking here?
So this is a big chart.
It is.
So it's the tender, it's
sweet.
Yeah, it's the tender rejection index for Los Angeles and Newark. So the same two markets.
Right. So let's just, EWR volumes up
27%.
27%. LA volumes down
18.
18%.
So tender rejection rates down 14% in Newark year over year.
Even though the volume was way up.
And tender rejection rates up 34% in Los Angeles.
Like a complete flip.
Complete flip.
Complete flip on both of them.
Makes no sense to the people that haven't been looking at market dynamics.
So you need to be looking at other data sets to figure this out.
It's-
Because you would not have thought that.
No, because volume does not necessarily, it's not a one-to-one relationship with revenue or, especially in trucking.
Right.
Because other people are in that market competing for that same business. And it takes a while for a lot of this information to get disseminated into the market.
Absolutely.
Mm-hmm.
And when it changes, like this changed with these two markets, you had normals for those markets.
Yep.
Right? And so you've heard it before. When you go into the Northeast, sometimes you get stuck in this whirlpool of not being able to get out of it because there's nothing coming out.
Right.
Well, now you got this source of freight coming out of the Northeast.
Yeah.
It's coming from Asia.
Yeah. And you have to adapt to it.
Yeah, you have to adapt to
It's
it.
not like all of a sudden all this freight's going to show up in LA again and go back to the way it was.
Right.
If you're sitting over there thinking, I'm an over-the-road trucker and I'm going to keep hauling this 2,500-mile freight across the country, rail, obviously, they can't make the service, so we're going to go ahead and just haul it up. No, that's not.
Yeah.
That's not the case. You need to figure out a way.
Interesting.
And there's definitely ways that you can get through that.
And that's it.
Yeah.
We've gone through them. So,
Yeah.
hey, and we're a little bit over time.
A little overtime.
So hopefully that was good. I enjoyed the discussion. Always
Yeah.
a pleasure talking with you, even though I talk to you multiple times every day. About different things. But it's really, really interesting. And maybe we'll just get some GoPros on and videotape those and have them edited about 90% of that out, and then
We're gonna have
we
to.
could air it.
Yeah.
But thanks everybody for watching every Thursday, 4:00, FreightWaves TV. Freight forecasting with Michael Vincent. We'll have Zach on again, I hope. And we'll take some deeper dives. So, we talked about the fact you need other data source. You need would you call it a variable model? Or
Multivariable model.
Multivariable
The more
model.
variables
Is that
you
like
have-
a bitemporal database?
Yeah, sure.
Okay. Multivariable
Binaural.
models and, to see what's going on. Because even those things that are like obvious, hey, more volume in truckload, rates are rocking and rolling, rates are going up. Not necessarily the case unless you're by looking at it. More volume into a specific market that's coming through and moving does not necessarily translate to not enough capacity.
Right.
Isolation, you're in your little LTL niche world, and the rains return to Southern California real heavy, and they have a bumper crop, not going to affect you in Atlanta.
Right.
Hold your hats. Yes, it is.
Right.
So you got to be watching and looking at all these other variables, and we'll dig into those more and more as these shows go on. Zach, pleasure. Thank you very much, my friend.
Thank you, sir.
Peace and love.